Greetings, this is another video in our CrashWatch series, and I haven't done one for quite a while, since March 30th in fact, because a lot of classical indicators are not working the way they used to because we might be shifting into a higher stage of the economy. Now what do I mean by that? This is the S&P 500, 5 years, correction for a COVID-19 pandemic, and then a huge amount of money printing causing a new high, and gradual decline as this money printing was being unwound. And it's not really being unwound, it's treading water because some countries are printing while others are not. But now we seem to be going higher again. I had said that we would reach 3,000 as a price for the S&P 500 because that's still not a low level compared to 2018, 2019, which were certainly not periods of market correction. Those were booming times. But this correction that was underway until September, October of 2022 now seems to be edging higher again as well. And sure, there'll be volatility, but what if the trend line is like this now, and we're shifting into a higher gear of the economy, which is something that anyone who believes in the accelerating rate of change is cognizant of, even though classic finance people are not attuned to those things. So let's look at the factors that are in favor and against this possibility. First, a very bearish indicator. The Federal Reserve has raised the Fed funds rate very high and without justification. Inflation has already been collapsing for about 7-8 months already, yet they have raised interest rates to the extent that the Fed funds rate is higher than the 10-year yield, and this is the delta between the two, also known as the yield curve. In a healthy economy, this number should be positive, 2 to 3%. If you take this 10-year chart, you can see that in a strong economy, 2 to 3% is the cruising speed of the difference between the 10-year yield and the Fed funds rate. Now this is negative, and this is negative for quite some time. And as I've often said, the area enclosed by this amount that is negative is the cumulative bearish pressure on the market, because the more this happens, the greater the chance of more bank failures and more fear spreading across the economy and thereby affecting all decision making. I can take even a 20-year chart where you can see that even this 2007-2008 housing bust did not have as negative of an extreme as we have now. That entire huge recession called the Great Recession had a lower area enclosed below zero than we are certain to have now. And that is a huge amount of adverse pressure on the stock market and was the crux of why I felt that there was a correction that could not be put off forever. We've also had bank failures as a result of this. This is also portending to a housing bust because mortgage rates are too high, which leads us to the next indicator. This is the 30-year mortgage rate in the US, and it was at a proper cruising speed of around 4% for the longest time. And then we have this COVID-19 situation where all the QE that the Federal Reserve did, which is very distortive for the housing market. Remember, I say that sending cash directly to people is the best way to do QE, and the complete absence of any integration between monetary and fiscal thought in the United States is really quite strange. And the only ideas that advocate for this are still very primitive ideas like MMT, modern monetary theory, that have no cognizance of the accelerating rate of change or technological deflation, but are at least better than what is being done now. So they made the mortgage rate unusually low, and then by tightening, they've made this rate more than twice as high. And as I've said, choose whatever floor you want, say 6% or even 5%, but 6%. And what is the area enclosed by this line and a floor of 6%? That is proportional to the amount of cumulative pressure on the housing market. Now, the thing about housing is if houses are down in price, then people won't sell if they're underwater unless they also experience a lot of job loss. And job loss is not what is happening right now, which is why this housing bust is not accelerating. It's pretty much frozen in a status quo because people are not in fact selling, thereby not achieving lower prints on housing transactions. But this is also bearish for the housing market and very related to that inverted yield curve that I spoke about before. So those are the negative factors. Now we will move to reasons why a market correction may not be very severe. As I've mentioned in other videos on this channel, artificial intelligence has hit the world at just the right time as things were weakening, and is kicking off another tech boom cycle centered around AI. Now that of course leads to a lot of hype and a lot of fraud and things like that. However, Nvidia's earnings have just done extremely well. It is at a higher point than it was even at the highest point of 2022, and if you look at this one-year chart, the share price has tripled in the last 6 months since the release of ChatGPT, which kicked off an AI craze, and this market cap is almost $1 trillion. Tripling in stock price is impressive enough. Tripling from a high base of 300 billion already means that there has been a catalyst for bullish activity in the entire stock market, because this AI boom is already underway to a huge degree, and it moves everything into fast forward. Now, this is not just like any tech boom. This has to be viewed within the context of the accelerated rate of change. In my Atom publication, in chapter 4, I did write about how at some point the stock market would just start to go vertical because of the speed of technological change. Now, I didn't think that would be as soon as 2023, and I don't think that has happened yet. But the longer that the stock market goes without a correction, the weaker that correction is going to be, and the closer we are to that eventual vertical takeoff, because the stock market will start rising to a ridiculous degree, and earnings also rising. The PE ratio will not be decoupled from the price of the stock market. The earnings of tech companies will also rise by a lot. And this is all preparation for a much more accelerated economy on the staircase to a technological singularity. Now, of course, the singularity is a good 40 years away in my estimation, give or take, but a much faster rate of economic progress as measured not by GDP, but by the speed at which technology companies and companies with a very high atom purity index, as I call it, achieve high valuation, it will be just faster and faster. And people with a classical old economy education, like those generic finance people, and worst of all, those PhD macroeconomists, and even worse than them, so worst than worst of all, are these gold bugs and other hyperinflation fearmongers who have no evidence to support their claims other than airy-fairy anecdotes that were conveyed to them by people 2 or 3 degrees removed, as we know. But the fact that this is happening now and happened before a correction might be extinguishing some of the bearish forces in the stock market. And that doesn't mean we won't have a correction, but my sentiment is shifting to a point where I don't know exactly whether we're going to have that correction I've been talking about, because we're now in 2023 and we're getting closer and closer to that inevitable big surge in the stock market derived by a greater diffusion of high tech in the economy. Nobody knows exactly when that will take place, but if we are already in the foothills of that, then a lot of corrective energy is dissipated. So that is the problem here. We have very classically bearish indicators of an inverted yield curve and high mortgage rates that would portend to a housing bust. At the same time, we have a tech boom and perhaps the stock market collectively pricing in an assumption that world money printing is permanent, which is what my Atom thesis advocates all along. The PhD economists will be many decades behind this revelation, of course, but the stock market, if it is pricing in an assumption of exponential quantitative easing because money printing does not cause inflation, as has been proven for many, many years now, and which I continuously prove with data every month, we are reaching a point at which the short to medium term corrective forces are perhaps running into the steeper gradient of the super long-term accelerating rate of change. Now, the fact that I'm getting wobbly on saying that whether there will be a correction or not at all could in fact mean that there will be a correction because the last holdout is now getting soft. But like I'm saying, I don't know, because these two opposing forces are very contradictory to each other, and historically we have never been in a situation where both of these huge forces were canceling each other out at once. And even if there is a correction, it could bounce back from that correction extremely fast as well. So the duration of the correction will certainly be shorter. Now, if you found this video to be informative and if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.